Hey, everybody. Welcome uh, to another round of PPP conversations. But hey, you know what? The SBA has found the megaphone again, and we've heard from them, so that's good. If you have not seen the SBA's recent FAQ document that was released, I think on Tuesday, let us know. We can send it to you. My email, if you don't, it's gfrey@trustbgw.com, gfrey@trustbgw.com, or you could just do a Google search, whatever's easiest for you. We're going to go ahead and pass it over to Adam here real quick, but we do have a number of folks jumping on this one. If you would, please. Good morning, Joe. Good to see you too. If you want to harass us and just encourage us, hit us on the chat, but please use the Q&A button to hit questions. And I do have a few questions that have already come in overnight and this morning. So Adam, you want to just jump in and then pass it over to Jack?
Sure. Yeah, I'll just highlight a couple things from the FAQs that I just really jumped out at me. That's a combination of, okay, cool, they confirm that, combined with, well, that's just not fair, and I hope that they fix that. So first off, the other thing that I find funny, because somebody asked, hey, what's the deal with what's going on in Congress? I've never really understood why, if we don't have a deal by Friday, there will be no deal. Like what? I mean, yes, we need to do a deal, but I don't know, I never understood, I'll either deal this Friday or there will be no deal. I've never understood rhetoric like that, but that's just my side. I don't even think that's political. I think that's just, I don't understand why you would impose a deadline to say, if it doesn't happen today, that it's not happening at all. This doesn't seem like one of those things. Like Jack and I are probably both very familiar with the concept of deal fatigue. This does not seem like one of those moments where deal fatigue and walking away from a deal should really set in. So anyway, thanks, Joe. Yeah, I'm unelectable. So the couple things that I noticed in this, first off, we'd had a lot of speculation. I think there was even some more clarification around what happens to payroll costs that were incurred before the cover period but actually paid during the cover period. So that'd be a scenario where, you pay 2 weeks in arrears. So the employee actually earned the money prior to the cover period, but you actually paid it within the cover period. The answer to that is yes, it is included. So I think when we were speculating on this, people were really struggling with how to spend the money in 8 weeks. I think the 24-week period cured a lot of that speculation about how I deploy the money, but definitively, especially for folks that were on the 8-week period and want to stay on the 8-week period, but we're wondering about that first money. No, you don't want to see my tax returns. The thing is that hey, that just makes it even easier by getting that first amount available. The second thing that I think we had these buckets of like, hey, that's black and white, seems like that's going to happen. And there was this middle bucket that a little bit gray, and then this third is, while technically allowable, I wouldn't bet my house on it category. Retirement payments. So, they're pretty definitive that, you cannot accelerate retirement benefit payments for the purposes of jamming them into the cover period. So, what I think where that still leaves a little bit of a gray area is that if your normal course would have been to pay your retirement contribution sometime in the August-September timeframe, but you accelerated it, what happens there? I think what it's pretty clear on is that, look, man, if I was declaring a 25% profit sharing match for the entirety of the year, I'm going to jam the entirety of the year into this 1 week cover period or 8-week cover period. The answer to that is no, you cannot do that. Third area was around the exceptions for the restoration of the FTE counts. They didn't really dive into FTE counts a whole lot in this FAQ per se, other than to talk about the one exception associated with I tried to find other people. Like I made an offer, the person wouldn't come back. I tried to find a similar person, but I couldn't find one. You know, you got to have written documentation, got to notify the unemployment office. They covered off on that in this document. Wasn't a whole lot of other detail in terms of what is written documentation and what is effort. You know, is effort just, hey, I, you know, put an ad with 2 words in the Charlotte Observer, or, you know, did I, you know, publish a full page, you know, banner ad on Facebook that I spent 100, you know, so still what constitutes best efforts. But what I found interesting is that's the only exception that they talked about. They didn't talk about the other exceptions that exist in this FAQ. So I hope they do that. But at least for this exception, you know, if somebody left and you tried to replace them but couldn't because you couldn't find anybody, there was some clarity around how you document this exception. And then lastly, and this gets to my, okay, they gave some clarity and I still think it's BS, really came down to how you do the calculations for S corporation owners and general partners with self-employment income. So C corporation is pretty clear. It's like you're an employee for the most part, with the one caveat that you couldn't have given yourself an exorbitant pay raise relative to 2019. For S corporation owners, you know, it's everything but health insurance for greater than 2% shareholder. The theory behind that is that you're supposed to gross up the wage number to cover health insurance when you're greater than 2% shareholder, and then you get an adjustment back off for that on your individual income tax return. So it's not considered per se taxable income by the time it hits your tax return. What I find is BS about that is that in Gary's number, if he's an employee, everything that he's paying for family coverage is includable in his gross wage number because I'm removing that from his pay. So if Gary makes 100 grand, but he spends, you know, 12 grand a year on family coverage outside of taxes to net 88, I still get to count the 100. Plus I get to count the $500 a month or $6,000 a year that I'm paying for Gary's individual coverage. If, however, I'm an S corporation owner, unless I got this wrong, oh, nay. Basically, it's 12 grand plus the 6 grand is removed from the calculation effectively because that's in my W-2 for the purposes of calculating payroll costs. So it just really means that the calculation for the owner wage for this purpose is reduced. Again, you know, probably people will be fine in terms of the 8-week versus the 24-week period. Even if you're a single employee S corporation, it's not fair though, in my mind. And even more unfair, which is the situation that I'm in and the situation Jack's in, is the K1 income. All right, got it. K1 from self-employment earnings, check. Always figured that was going to be the case. Why do I need to reduce that again by Section 179, depreciation? Like, why am I reduced by the amount of depreciable property? That doesn't show up anywhere else. These calculations, I mean, that represents cash money that I had to spend to otherwise, you know, have an active trader business. So that one just seems totally unfair. And you know, if you wanted to rewrite this, then go back and say, well, have it be, I don't remember the box number, but have it be what your draws were, capped to 100 grand. But trying to get to the mechanics of saying, what did I really earn reduced by Section 179 just seems crazy. Again, probably you're going to be fine anyway based on the caps, just thinking through the BGW client base, but it doesn't change the fact that it is wholly and absolutely unfair. With that, my tirade is done. Off to you, Jack.
Okay, so some of the things I'll say next are reiterations of what you said, but and we had talked about before we got on this call, are we going to go through each of the FAQs and provide commentary? And I just don't think that's productive. I think that in a lot of cases, it's more productive for all of you to pull up the FAQs, go through them, apply them to your situations at your businesses, and go from there. So I don't think it's really for us here in this forum to go through calculations via the Q&A. What I would like to do though is I went through this and I have selected some things that I'd like to share or reiterate as things that either we thought we knew were correct, or we weren't sure but we had some thoughts, or that are things that are different than what we thought. And so let me just go through some of them, and I can even tell you which ones I'm going through. So if those of you have it in front of you, either electronically or on paper, can take notes. But question number 3 on the first page is, if a borrower submits timely loan forgiveness, does the borrower have to make payments on its loan prior to remitting forgiveness amount? The answer is no, as long as the borrower submits its loan forgiveness application within 10 months of completion of the covered period, the borrower is not required to make payments. So basically what it's saying is that you do have the full amount of time of, once you have 10 months of the completion of the covered period to submit your forgiveness application. And we'll get into the August 10th date here in a minute, but because I know there's questions about that, and I was listening in on a seminar yesterday that provided some guidance on that from a banker's perspective. Question number 2 under loan forgiveness, and Adam had mentioned this, are payroll costs that were incurred before the covered period but paid during the covered period eligible for loan forgiveness? The answer is yes, as we thought. It's incurred or paid, so it's not versus. For purposes of calculating cash compensation, should borrower use gross amount before taxes, etc.? The gross amount should be used when calculating cash compensation. And the next question is, okay, what is covered in that amount with respect to payroll, salaries or wages, in the loan forgiveness, or does it include tips, lost commissions, bonuses, incentive pay? And the answer is payroll costs include all forms of cash compensation paid to employees. Again, kind of things that we sort of knew. What I think is a point of clarification though is when you talk about group health care benefits considered payroll costs that are eligible for loan consideration or loan forgiveness, payroll costs do not include expenses for group health care benefits paid by employees. So my point there is, without going through all that, is make sure you understand who is the pay or who is paying for this ultimately. Is it the employer or employee, and what is covered and what is not? A lot of this has to do with definitions, and sometimes the same term has a different, not definition, but application under the circumstances. And I'll give you an example of that in a moment.
Yeah, can I interrupt you for a second, Jack?
Of course, yeah.
So, we had, this isn't a shameless plug for Hire BGW to help you with the PPP application, but I'll just give you for instance, we had some clients who reached out and said, can you help me? And then, 2 days later said, I don't worry about, my payroll company has it. I think I got everything else. Using this example, you cannot use the entirety of the Blue Cross Blue Shield bill for this calculation because that includes everything as an example. So unless you pay full health insurance for everybody, you can't use it. You have to go through the process of calculating what was the benefit that you provided. So with that, I'll shut up.
No, that's fine. Thank you. So some other interesting nuances are non-payroll costs included during the covered period but paid after the covered period eligible? And the answer is yes, incurred during and paid on or before the next regular billing date, even if the billing date is after the covered period. But then you start getting into some of the nuances. So one of the questions is, if a borrower elects to use the alternative payroll covered period for payroll costs, does the alternative payroll covered period apply to non-payroll costs? And the answer to that is no. The alternative payroll covered period applies only to payroll costs, not to non-payroll costs. And they go into an explanation about that. And as a general comment, when you go through these FAQs, in many places they give examples, and their expectation is widely applicable examples, or at least some way, a methodology and demonstration as to how they're using the formulas and the FAQs in their perspective. So another question about interest on unsecured credit eligible for loan forgiveness. The answer is no. What is interesting is their explanation. Payments of interest on business mortgages on real or personal property, such as an auto loan, are eligible for loan forgiveness. However, I didn't say however, but I'm saying however, interest on unsecured credit is not eligible for loan forgiveness because the loan is not secured by real or personal property. Interesting. I mean, what makes, maybe I'm missing the point, but what makes a secured loan more important than unsecured loan, other than the fact that if it's secured, then they can come after the collateral and they're trying to protect your assets from debts. I mean, that would be a logical explanation, but little things like that are explained. Let's see, what else? Oh, and the last thing that I would share is, it's the very last FAQ, is for purposes of calculating the loan forgiveness reduction required for salary hourly wage reductions in excess of 25%, are all forms of compensation included or only salaries and wages? And it says, for purposes of calculating reductions in loan forgiveness, the borrower should only take into account decreases in salaries and wages. So finishing out that thought, if it's only salaries and wages, it's not all forms of compensation. And I just a minute ago kind of went through what those other forms of compensation might be. I think there was one more that I wanted. Okay, yes. On loan forgiveness, when calculating FTT reductions exceptions in Table 1, do borrowers include employees who made more than $100,000? And the answer is yes. So remember, there's a $100,000 threshold, and that is important for a lot of reasons that we've talked about. But the answer is the FTE reduction exceptions apply to all employees, not just those who would be listed in Table 1 of the loan forgiveness application. Borrowers should therefore include employees who made more than $100,000 in the FTE reduction exception line in Table 1 of the PPE Schedule A. My point there is that don't assume that just because the employees that were included in that sheet, because they were, that they were at $100,000 or less, that isn't a benchmark for the 25 for the FTE reduction or the safe harbor. So keep that in mind as well. So what in summary of all of that, our recommendation to all of you is to, again, go through the calculations. If you've gone through them already, go through them again, applying what is in here that helps further inform you and guide you through that process. To the extent that you had any questions, were unsure about where you're putting on the right number, where you're doing the calculations, which maybe actually change what you put down. So go through that. Let me talk about the August 10th date. So in the past couple of days, there's been information, and I think I've shared with you that we have some SBA loan experts, lawyers that are in contact with the SBA and with the groups that are influential, I guess I would say, in SBA and Treasury kind of things. And she has told us internally that she confirmed with the SBA that lenders are not required to have their forgiveness portals available on August 10th, but lenders may wait to see the results of pending legislation, given the possibility that loans of 150 or less may not need to be submitted into the portal. The SBA, however, will have their forgiveness portals available on August 10th. Put that together with some information from some bankers that basically, and we've had this question come up, and I think there may be one actually in the queue. Hey, I'm all good. I've applied correctly, I've used my funds correctly, I'm in the money, I'm not yet at the end of my 24 weeks. Can I go ahead and apply? Well, first of all, you can't physically apply yet. But those bankers are saying, kind of like what Adam and Gary and I have been saying, is that why would you do that? Other than for peace of mind. You know, if you're one of those people, and I'm one of those people that has to have a list and likes to see the checkbox or the cross out, then fine. But I don't think that that outweighs the possibility that things may change. So if you have this long runway of applying for forgiveness, then why not wait for that? Now it's clear, or at least in bankers' minds that I've talked to and heard, that even if you apply early, let's say that your bank was accepting applications on August 10th and you were good to go and you wanted to do it, but you weren't at the end of your 24-week period, you are still, once you submit that application, you are submitting that for the entire 24-week period, you were in the money, you were fully compliant. So unless you have a crystal ball, or you are, you know, very unlikely to have any changes in any of the many variables that would impact changes in your application, it seems logical that you would wait at least until the end of your 24-week period, if not longer. So, you know, those are my thoughts on the August 10th date, the portal, the waiting. I mean, some of the questions that we've been asked over the course of time in recent weeks. So I will stop there.
All right, that's awesome, because you guys have already answered a few of the questions that have come in. You're really good, but we'll still ask those questions. But before we do, I think it's worth noting that Jack is in a collared shirt today because he was named Businessman of the Year in Latin American Excelente. So congratulations to you, Jack. You wouldn't say it, so that's why I'm saying it. I think it's worth noting. So congratulations, man. And
Thank you very much. I'm very humbled by it, but a little bit embarrassed. I am turning red. You probably can't see that on the screen, but thank you.
Yeah, that's good. All right, so a few questions. So the first one, Mark, are banks stalling, or are they not able to run through the forgiveness applications yet? So additional commentary? Adam?
Yeah, I think Jack nailed it, that the nobody's stalling. It's just that they're not, you know, they're not super incentivized to rush this either. In fact, they're disincentivized because, you know, if they end up processing a whole bunch of applications that otherwise were going to get turned into grants anyway, like that's just a waste of effort on their part that I don't think they want to do.
Yep. And you also just addressed this next question, Jack, with PPP loan forgiveness, 24 weeks. Can you submit your forgiveness application at week 14? Anything that you would add to what you just talked about?
No, I mean, you know, it's a matter of opinion, I think, but of popular opinion and just common sense. I mean, if the rule truly is you are certifying as of week 24, I don't think you really practically can do that until you actually cross that line. And again, to again and again reiterate that, you know, why would you apply not early but timely when you have such a long runway to do that? I just think that there are going to be so many changes, and what a key component, what we don't know yet, and this is now I'm going off on a little bit on a tangent, is that apparently the you know, the negotiations in the Senate discussion has stalled out somewhat, and even with the president giving kind of an ultimatum that if you don't make up your minds by Friday, I'm going to do some stuff, whether he can or can't. He's going to do it, whether he can or can't. But does it stick, essentially, is really the question. And so even with that, I know they're hustling as much as they can. I think that without commentary on the governor's decision to stay at phase 2 instead of phase 3, and as other jurisdictions, other states have to make those decisions, obviously that is going to impact what happens with companies, what happens with employees, what level of incentives and subsidies need to come from the federal government, from other places. It's also going to impact, you know, where is this money coming from? You know, we're magically minting money, which basically means, for those of you, most of you know what that means, is basically we are putting ourselves as a economy, as a society, further in debt. I mean, that's it doesn't appear from anywhere other than from our own pockets. So there's all those considerations going around, swirling around on Capitol Hill and elsewhere. So that's a long-winded way of answering the question, but there's, you know, just all those factors that we still don't know. So back to being another reason why you should wait, we think, is because we don't know the next set of money that's coming. What is the interaction with the first set of money? And are there going to be changes that say, well, you know, if you didn't quite make it, meaning you didn't fall into all of the exceptions, or you had a reduction by, you know, you weren't able to bring it up to full strength by that 24th week or the measuring period, well, maybe that's okay, because we're going to extend that. Rather than giving you more money, we may extend the safe harbor, which is kind of like giving you more money. It's basically not you know, forgiving more of it. So again, just various ways to, I don't want to say manipulate, but to provide benefits, possibly non-monetary benefits, to all of us. So again, but once you, what we don't know, but is probably logical conclusion, is that once you submit that application, you're probably not going to be able to get it back. So
Yeah, I think that's a safe assumption. Next question is up from Lori. Thanks so much for the webinars. They've been helpful to me as a small accounting firm in helping our clients move through these challenging times. Question in regards to the application for forgiveness. I've been hearing a rumor that if PPP loan was under a certain dollar amount, there may not need to be an application for forgiveness submitted. And we did talk about this a little bit, but I want to read it anyway. What have you heard about it? Will there be a webinar about it? Do you have any information on this, or can you direct me to a site that has the information? Thanks.
There's nothing currently, and Jack, I'd ask you to hop in if you have something to add or that's contrary. But yeah, I think one version of the proposal was 100 grand, another version of the proposal was $150,000. But it's in both versions, the House version and the Senate version, you know, both had a floor whereby, you know, they were following the Pareto principle by count, meaning, hey, we could grant, you know, only 20% of the money, but it'd be 80% of the loan volume. If we just said, look, no application needed, that money is yours. And it said, I think one version had it at 100 grand, the other version had it at 150 grand.
yeah, and the logic behind that is accurate, meaning that it's a large number of people with small per loan amounts, and if they can find a way to facilitate that, for a number of reasons. One is that just so they don't have to process forgiveness applications, but they're also making a lot of assumptions within that. First of all, that if there are cheaters in there, either purposefully or accidentally, that the assumption of risk of giving someone money when they don't deserve it is okay in light of the burden of the logistics of processing those applications. So they want to be done with that. And so whether it is, and so there's two aspects of that, which is that if just simply if you are at $150,000, you don't have to do anything. The next level would be is you're at $150,000, but for administrative purposes, we want you to submit a piece of paper so that we can put it through our computer algorithms, and then we might catch some bad actors in that. That would require them to build the algorithm to check all those applications and implement that. And remember that the applications first go through the banks, and then it goes to the SBA. And The other question, or another question, is who gets left holding the responsibility, the financial responsibility, the penalty for loans that were improper or improperly processed. And right now, it seems like it's always been on the borrower ultimately. So one of the hesitations in related to this August 10th date that the banks don't have to is, and as Adam said, they're not incentivized, they're actually disincentivized, is because they want to make sure that they are not responsible at all for any bad loans, essentially. That they are going to get the money, the little bit of money that they were promised, and all they have to do is either do nothing or accept an application and float it forward without having to do any due diligence. And there's, once you get into the $1 million level, there are requirements of the banks to do certain things, minimal things essentially, in order to validate those forgiveness applications. And if they don't do that, then there are penalties. But ultimately, it comes back on the borrower. So.
Well, here's the next question from Barrett. Just got our PPP forgiveness calculator from our bank, and it just asks, how many employees do you have at time of forgiveness application? We were under the impression that it was only based on full-time employees. Is this no longer the case?
No, I mean, they didn't opine on the FTE calculation anymore in the FAQs or change anything. So I'm assuming that what happened in this case is very similar to what happened in the application process, is that your specific bank said, oh, let's get a calculator out, and it's wrong. This is anecdotal, but if I had to guess, well, actually, it's not anecdotal. The number of calculators that were produced, and this isn't a knock on banks, they're doing the best job they can, but best job they could, but the number of banks that produced an accurate calculator for the loan amount in the first week or so of the application process, 0. So I think that what you got is somebody that produced, in other words, it may technically be correct what they put down there, but what they didn't say is, by the way, for the purpose of this calculation, run through this calculation before you put this number there, which is what the underlying instructions read. So nothing changed. It's still supposed to be average FTE. So until that changes, then don't just put the count down.
All right, next question is, if a client has spent the money right away during its covered period and met all FTE requirements, et cetera, for forgiveness, it seems risky to wait as new rules cannot help any more than full forgiveness, correct?
I think that unlike most other government programs, it's actually the contrary. Every single time that an FAQ has come out, other than the brief tirade that I had about owners of companies, it's always been business friendly. I don't see a reason why that would change. There hasn't been anything that's come out of this that's been punitive. In fact, it's all been helpful, in my opinion, and pro-business friendly.
And I think that, there is, and I can see a scenario where that there has been, you're totally compliant, there's been no penalty, so there's no deducts, you're within the safe harbors, or you don't even need the safe harbors, that there is the possibility that you might want to go ahead and do it, and assuming you're past the 24-week period and your bank's accepting. The challenge is that, as I said before, the interaction between what is coming and what is already in place. So we've seen things like the 75 go to 60%. So what if there is an ability to, let's say, again, just totally hypothetical scenario. You take bucket of money 1, add it to bucket money 2, put them 2 together, even though they're 2 separate buckets of money, that they're treated as commingled. And then the rules for the commingling provide a better benefit for you, generally speaking. Or it is that that there are restrictions in bucket number 2 that would not allow you to, and you filed and you're done with bucket number 1, you've asked for forgiveness. Now all you have is bucket number 2 and the rules that are related to that, that for whatever reason, let's say it was a 20% minimum requirement on non-payroll expenses. But for some reason, if you combine the two, there's a blended amount that would allow you to use more of the blended amount for non-payroll expenses. Said another way, more of the new money for non-payroll expenses combined than if it were separate and apart. Then you might consider. So I'm not trying to make people paranoid or raise expectations that any of this is going to happen. There is a risk that waiting might have an impact on, the forgiveness package that you have and you're good to go. But to Adam's point, Jack theory, Adam theory, don't see that happening, because the goal is to be pro-business, pro-employee, and not punitive. And I think the things that we see that have been punitive have been, in many cases, inadvertent, because they just couldn't think that far ahead. They were so focused on what was right in front of them, which they had to be. You can't, there's not enough hours in the day to do all the what ifs. And so you focus on what's in front of you to get it out the door, and then you deal with the course corrections as time goes on. So
yeah, I think to hop on another soapbox for a minute too, from a tax perspective and also a banking covenant perspective, is that, again, we've kind of harped on scenario modeling and stuff like that to show, kind of your what if, but, I've only had a few clients that have gone through covenant calculations with their bank at this point. And the answer is, you cannot include the PPP funds and associated income for the purpose of passing your covenant test. Like, our advice was add it in, because obviously you couldn't hit the covenant without it, but then start the negotiation process with the bank. So what we've seen is either covenant waivers, or 2, modifications to reduce the covenant to something that will pass and not require a waiver, to the point where, we've got one client that's got a debt coverage covenant of 1.0, which, I mean, that's as low as I've ever seen it. Because that basically means that you're earning just enough to meet your obligations, which seems fair. Point being that even from a financial reporting standpoint, there's no incentive for early forgiveness. So if you go from the tax perspective, just think about it this way. If you get money forgiven in 2020 and they have not made a tax law change, that's taxable income in 2020. And you're writing the check on April 15th, 2021. And that forms the underlying basis of your estimates for 2021, unless you adjust them, to be what you expect, which we would do, but a lot of CPAs don't do. If alternatively, you're to wait 1 minute past the stroke of midnight, 2021, now that's 2021 income. And by income, I mean, like, they don't do a rule change to allow you to deduct the expenses associated with what was forgiven. Well, now that's 2021 income. And that money's due April 2022. The likelihood of a tax rate increase in 2021, I think at this point, is 0. So for all intents and purposes, the rate's going to be the same. Why would you ever want, like, that? That makes me physically ill to think of someone who wants to pay taxes before they're legally due. So if for no other reason, then, why not wait until you have visibility into the tax disposition of the loan? Look, if they decide that, hey, you can go ahead and deduct the expenses sometime in calendar year 2020, I don't care either way. But if they haven't resolved that by the end of this calendar year, even if they resolve it in 2021 to be retroactive to 2020, there's no benefit in doing it in 2020, because you could just wait a whole nother year and have use of those tax dollars for other purposes.
All right, this next question is probably for you, Adam, and this is from Mike. And the question is on the proposed second draw loans for PPP in the HEALS Act. And the eligibility requirement includes the following phrase, quote, had gross receipts during the first or second quarter in 2020 that are not less than 50% less than the gross receipts of the entity during the same quarter in 2019. End quotes. What does gross receipts mean in the above phrase? Is it the amount of cash received, or is it the revenue earned or accrued considering that we are a C Corp and our taxes are accrual based?
I mean, they never really defined how you calculate revenue for the purposes of the employee retention credit, which is how this is based off of. In terms of, is it accrual or is it cash basis? So, you know, honestly, I probably would use whatever answer is the most favorable to me. You know, and if the most favorable answer is to follow my tax reporting, then I would do that and pin my hat on that, pending further guidance. If it was more favorable to use accrual, then I would use accrual accounting, because in theory that would show up as an M1 adjustment that would be translatable to anybody that goes and asks the question. So I honestly would pick the one that's the most favorable for you, because I think that either is supportable.
All right, this next one is fairly lengthy, but stay with me. And this is an anonymous.
One question, 5 subparts. I was kidding.
Yeah, exactly. Well, there's some narrative behind it. So during the last 6 weeks, we've begun furloughing our company for a week at a time. We have a great workforce and don't want to lose anyone. We know that we have business in the future. It's just gone away entirely since the pandemic has taken hold. We're trying to be sure that our employees are as taken care of as possible while keeping our company afloat and not digging any massive holes that we will have to dig out of. With the federal government not adding anything extra, a furlough week is rather painful right now. We've on the NC unemployment website that we are able to give support payments attached to our employees, and I've copied this information and attached it below. And I have, just so you know, to this anonymous person, I did respond back, and I forwarded that to our FAQ at trustbgw.com expert center. So anybody that does have specific questions that if we have not answered them here, that is another resource. Again, it's FAQ at trustbgw.com. All right, so the amount isn't large, but it would help to pay at least their weekly benefit deductions and perhaps a small deposit for groceries. My question is the tax and benefit of handling of this support payment. The directions aren't very specific. It says that it is not wages. Then it says it is payment for past work. Payment for past work seems like taxable wages, but it says that it's not wages. If it's not wages, then can we tax it and deduct the benefits?
Well, you know, I don't know the answer to this, so part of this is going to be speculation. So I'll try to stall Jack while you look up the answer, but it's okay. You probably don't know the answer either. That's pretty deep into the unemployment law. Jack Shaker said, no, I don't know either. But if you kind of think about, you know, what's the intent of what North Carolina is trying to accomplish? The intent of what North Carolina is trying to accomplish is that you as the business owner still get a deduction, but for whatever reason on the employee side, they don't trip over the $70 a week or whatever it is that's considered compensation that would otherwise reduce their unemployment benefit that's received from the state of North Carolina. So I think in this instance that, you know, using as an example, you know, if you paid the employees health insurance that they otherwise would have normally paid themselves, you know, that would be like, they would normally report that on their wage. But in this case, just saying, I think you can still go ahead and pay that, but not have it be considered compensation to them, which ultimately I think gets back to what is the employee able to report to otherwise receive a benefit, the max North Carolina benefit, without, you having to jump through a bunch of hoops. I think that's the intent of what they're trying to get at is, hey, you guys can, you can still help these guys out, with benefit type payments, so they can still get unemployment, whereas those would have normally been considered reportable wages.
Okay, the next question is from Karen. I may have missed the dialogue on safe harbor contributions. Are they allowed as a payroll deduction or not?
They're allowed as long as they're not accelerated. In other words, you can't make a year's worth of safe harbor payments in, 8 weeks or 24 weeks.
And so this one is, did Adam really just say that taxes will not go up in 2021? Adam.
Yeah, I'm 1,000% confident. And again, I'll bet at least half my house on it. Taxes will not go up in 2021. Because if you just think about what has to happen for tax rates to go up in 2021, first off, the administration has to change. First, presumably there would have to be a turnover in government such that you pretty much had the ability to pass a tax rate increase in whatever format that it comes. Secondly, you would have to get that done in the December timeframe, but they're actually not even sworn in until January. So basically it'd have to be the old guard making the increase. And the reason for that is, and someone can fact check me on this and tell me that I got it wrong, but man, tax rate increases are never retroactive. They're always prospective. So I just don't see a scenario where you're going to see. Now, do I think tax rates are going up in the future? Absolutely. But I think it's going to be more 2022, 2023. I think we're probably pretty safe in 2021 because it's never happened that these guys, they can't even pass a freaking benefit package, let alone the ability to pay for it. So the likelihood, yeah, you can record it and then pass around. The likelihood that they can the likelihood that they'll actually pass a tax rate package and for the first time ever make it retroactive to all of 2021, pretty low.
Yeah, so the chat came in and can you record this? As a matter of fact, we are recording this and every one of these things is put up on the YouTube channel of BGW CPA. So Google BGW CPA YouTube and you'll find every one of these crazy webinars up there, and you'll find today's up there later on this afternoon. So next question is from Vicky. It's good to see you here again, Vicky. I know we talk about tax, but a GAAP question, if that's okay. I've heard GAAP assumes forgiveness and you have to put your forgiven loan in your official 2019 financials. I've heard you have to make a good projected calculation of how much forgiveness dollars will be included, and include that on your GAAP financials. Is that correct?
Yeah. So what was supposed? So you use the calendar year 2019 for GAAP purposes. Again, this implies that there's actually been a FASB pronouncement. I don't think there has been, but there's been guidance around how you should disclose PPP for 2019 and how you're supposed to disclose PPP for 2019 is to include the amount of the loan, the anticipated forgiveness amount and what any potential balance due might be, along with what's your COVID mitigation plan. Like that's supposed to be a disclosure set of information that appears in your 2019 financial statements. Now, in terms of the actual recognition of the loan forgiveness income, if you wanted to take the most conservative approach, it would be the point at which you actually receive forgiveness from the bank. I think if you wanted to take a little bit more aggressive approach that I think is maybe a little bit more realistic from a reporting standpoint, based on everything we talked about delaying, it would be that you believe that the loan will be forgiven and you're pretty dang confident of it. And the only variable would be, you need to accrue a distribution or an income tax expense associated with the disposition of the taxability of the proceeds.
Excellent. And hey, this is a little shout out to Tim. So you've been paying attention. So thanks for doing that. He likes the beach background best in Jack's virtual background. You know, he wasn't sure whether he should show his office today or go with some of the virtual backgrounds. And we were like, hey, just mix it up and see if anybody notices. So Tim, you get the award today. Unfortunately, the check will be in the mail from the U.S. government. So just, you know, don't hold your breath on that one.
Which brings up a very important point that I tell my kids all the time, that even when you think no one is watching, people are watching. Because I thought I was off camera when I was doing that because someone else was talking. So I hope I didn't make any silly faces or anything else embarrassing on the recording now.
It doesn't matter. You won the businessman of the year, so you get a pass.
Okay, thank you.
Any other questions out there? We still have a few minutes. Here we go. Another one has popped up here. How was Gary's lesson last week? Oh man, Mark.
Show him the scar and the bruise.
Why'd you have to bring that up? I actually tore my bicep. No kidding. So my water sports involving power boats, I think those days are gone, and it's really sad because I used to barefoot and also be a pretty decent slalom skier, but trying to get up on a wake surfboard at 11 miles an hour was too much for my distal tendon in my bicep, so it snapped, and I'm in rehab right now. But and I'm not going to do surgery.
But funny side note, when I said by funny, it's not very funny. Julie looks back because Gary was down. It's like, I think Gary's really hurt.
Yeah, I really was hurt. You can't really see it now, but this whole thing is completely black and blue. But and since I am allergic to everything from baby aspirin to Advil and Aleve and any anti-inflammatory, the first night was a little rough, but we're on the mend. So adapt and overcome. That's the word and the phrase for 2021, I think. Adapt and overcome. So Mark, thanks. You were paying attention, and I appreciate it. Any other questions out there? Man, we had 65 people on today. Thanks for taking time out of your day to join another crazy train. These are a lot of fun, at least for me. So evidently they're providing some value. So again, we'll be putting this thing back up on YouTube on the BGW CPA YouTube channel. And we'll plan on being back here on the same time, same bat channel. And the question is what environment will Adam be in next week? That's the next question. And the next question is will Jack be wearing a collared shirt or not? So stay tuned. It's a cliffhanger. So let's see if there's one other thing that has come in here. Yeah. Welcome, Joe. Thanks, everybody. Have a great rest of the week and great weekend. Be safe out there.
Thank you.
All right. See you guys.
See y'all.